Welcome to the Rose Show podcast.
Thank you for putting the time in to put all this together and
Oh,
organize.
you're welcome. Thank you. It was your idea. So I'm going to give you all the credit. It was your idea, which was excellent, Matt. Risk management, I have to say, I think it's the sexiest topic because it's so important. And I think it's like probably the number one most important thing because it doesn't matter how much you make. It's about what you keep.
Yeah, I mean,
And if you don't,
I pretty
yeah,
much view everything through a risk management lens. So it's like kind of the all-encompassing topic for me. And I just thought it was funny because I see how Joe Fahmy kind of keys on, those the news flashes that used to come up of like the most important election of our lifetime. He keys on, he kind of riffs on that with his spaces and says the most important CPI number of our lifetime and stuff like that. Which I think is hysterical. So I was just thinking of
I
this as
love
like the
it. Yeah.
least sexy spaces of our lifetime.
That's why it's the market reality
Right.
check for everyone. No fantasy
Exactly.
zone. Oh, here's Jack. Cool. Hey Jack, I'm gonna get you in. Let me see my phone. There it is. Okay, there we go. So yeah, there's so much to talk about. I'm excited. Oh, cool. Jack said,
Hey
"Hey
guys,
Jack."
how's everything going?
Good. How are you?
Great.
Pretty good.
How are
I'm
you?
doing good. I got cut up an apple to snack on while we do this space. Got a glass of water with me. Got my
Awesome.
dogs with me, so we're all good.
Perfect.
We're set up to go.
We're great. As long as the dogs are here, we're all good. We're ready to go.
Absolutely.
So okay, great. So here we begin. 2 o'clock sharp. You
Perfect.
are punctual, Jack. Awesome. Well, I gotta tell you, you guys are both great. Love you guys. So okay, welcome to Market Reality Check, risk management and reality trading in all markets. Thank you for joining us this afternoon. We hope to make this space educational and lots of fun. Quick disclaimer: please do not construe this as investment or financial advice. I'm Rosanna, your host, and I'm here with co-hosts Matt Petralia, CMT of Trading Equilibrium, and Jack of Alpha Charts. In this space, we will give you a market reality check. It's a no fantasy zone. We will discuss true reality-based risk management thinking and what it means in trading while going through various concepts and techniques. As the famous Charlie Munger once said, the best thing a human being can do is help another human being know more. And that is what we hope to accomplish here as we provide you with a market reality check, dispelling any fantasies you may have. So let's begin. First, please tell us about yourselves. Matt, would you like to begin?
Sure. So thanks for that introduction, Rosanna, and thank you for all of your help organizing this. I'm a Spaces newbie, so this is my first shot at this. In any case, my name is Matt Petralia, and I have been a trader independently for going on 25 years now. I always say 20 plus years, but the time keeps going by faster and I keep getting older. So it's going on 25 years at this point, and I have been in and out of trading full time. And I am a swing and position trader, mainly momentum trading in the swing accounts and trend following in the position trading strategies that I use. And I really use kind of clean technical analysis. I recently got a CMT. It was something that I wanted to do for a long time, but I've always been dependent on technical analysis. Prices, as Brian Shannon always says, only price pays, and that is how I look at the market. And for me, risk management is basically the lens that I view just about everything through. So I think a lot of people view risk management really briefly as just you have a strategy for stops. For me, it's basically a term that encompasses almost every decision I make in the market. So I come at trading from a risk management mindset. So that's my story in a nutshell.
I love it. I think we can all use a little more risk management. I know I can, so I have a lot to learn from you, Matt. Thank you. Jack, could you please tell us about yourself?
Sure. I'm basically the guy next door. I work full time outside the house. I've been trading for about 10 years or so. Um, And like Matt, I like to keep my charts very clean, and I like to let the chart, the price really tell the story on the chart. I think that's really important because if you let that and you unclutter your charts, I think that helps immensely. And just I'm a relative strength guy. So I'm always looking to see what sectors and what parts of the market are exhibiting relative strength. And then I hope to find, the strongest sectors, strongest subsectors, and then the strongest names within those subsectors. And hopefully, we make some money off of it, right? That's that's always the goal. So, there's nothing, flashy about me. I'm very kind of, blue collar when it comes to my charting and everything else. I call it how I see it. And I'm just, try to be as honest as possible, not only, like on FinTwit and everything, but to myself on what I'm doing and what I'm seeing. Because I think a lot of times that, we kind of have a narrative in our head. I'm sure we'll probably get into all of this, but we have a narrative and we try to make that narrative work. And when it's not working, we don't recognize it sometimes. So that's, but basically, yeah, I'm the guy next door, and that's who I am.
I love it. Well, we love the guy next door. So, and we love your transparency and your honesty. And I have to say, you guys are both fantastic people besides excellent traders. So I'm so honored to be here with both of you today. You know me, I'm options trader, I'm swing trader, long term. I do a little bit of everything. I don't really day trade though. That's not really my thing. I've never taken the time to really focus on that because I'm just passionate about the swing, the options, the long term. I'm very fundamentally based. And most of my investments, I always go deep dive on the fundamentals, and that's for swing and long term. Charts for me are simple. I keep it very simple. I keep everything simple. I think simplicity is key. Less is more, so I do relative strength as well. Moving averages are key, pivot points. I don't like to have too many lines on my chart. I do Fibonacci a little bit, but when I look at a chart, I just look at it clean. So I agree with you both. I'm an entrepreneur. I have businesses that I run. I also, I'm an investor. I do a little bit of everything, and I'm podcasting now. I love speaking. I've always been my passion. I've been a speaker for most of my life. And I had a real life before Twitter. This is just a small, tiny little, thing. I've only been on here a year or so, but not even, I don't know. I don't even keep track anymore. But I just do what I love. And that's my thing. I'm passionate and I love this. So let's dig in and let's start talking about risk management. So, I think we should start with, this is a great idea. Matt has so many great ideas. And I have to tell you, so impressed with both of you with everything. So, and Matt mentioned how we determine position sizes, set stops, entries, how to manage the risk per the trade, and all that. Could you get started, Matt, with that discussion? I think that's so important. That's a great beginning point.
Yeah, sure. I think you have to start there, right? Because I think most people's perception, like I was saying when I was introing myself, is that risk management starts and ends with your position sizing or where you put your stops, and that's it, right? As long as you have stops, for instance, for some people, they think that that's the be all and end all of risk management, right? And I think it's much more than that. Nevertheless, that really is kind of the backbone, the nuts and bolts of any risk management system is going to include knowing where you're wrong, and knowing how you're sizing. And that's all a reflection of so many different ways of handling yourself within a market and different market environments. But for me to address those kinds of nuts and bolts issue in terms of how I place stops and how I position size, I am not the kind of person that places stops, let's say 8%, just maybe not a random number, but a specified number, say 6 or 8%. I'm not the kind of person that does it percentage based stops. I'm always looking at a technical level. It doesn't have to be a complex technical level by any stretch of the imagination. It's not a level where I see, 15 different indicators aligning or anything like that, but usually it has to do with either a moving average or a low of the day in a previous trading range, or a key pivot level. I mean, those are the main things, and you usually really clear levels where if that level is breached, I don't want to be involved anymore. Specifically with swing trading, where my main focus on swing trades is I want to be right fast. I want things to work almost immediately, quite honestly. So if they don't, I want to get out, and I don't want my capital tied up. So I will place a stop at a certain level. Usually, I'll find a pivot or a day low to put a stop. So if I enter, let's say I enter based on a pivot move above a downtrend line or above an actual support resistance line, I may just simply put my stop below the day's low or the previous day's low. Simple as that. And then in terms of sizing, I'll size off of the distance between my entry and the stop. And I'll just use a simple position calculator you can create in Excel. And there's actually people that have created these. There's even an app for it, actually. And that will give me the right sizing number of shares to take for the risk that I want to put on. So for me, my kind of bread and butter risk percentage is 50 basis points. So 0.5% of my account. So 0.5% of my total trading account will be at risk, meaning if the stop is hit after I take the trade, I will lose just that amount. So 50 basis points is what is at risk. It's not the total amount of the trade. It's not that I'm putting 50 basis points of my account into the total trade. That's how much I can lose, right? So that's how I position size. And for me, those are, like I said, that's just the absolute nuts and bolts. Those are the things that you just absolutely need to have. For me, I will never place a trade without having a stop, ever. Never. Just never happens. Certainly I did that in the very beginning, and the results were disastrous at times when you don't have a stop, and then you enter into that kind of psychological spiral downward where, oh, if I just hold on a little bit longer, it's going to recover, it's going to recover, it's going to recover. And then you're staring at a 50% loss after a couple of weeks, right? And for any stock that I can show you that bounces off its stop, almost to the penny, and you get frustrated with that, I could show you another one that goes down 30% in the next 3 days and would really leave a mark. So that's the nuts and bolts of how I handle stops and percentages of my position sizing. So in a really choppy market like this, I can reduce position size to 25 basis points, which I have been doing. I've been taking 1 or 2 trades at 25 basis points, quite honestly, and I can talk about that later as well. And then when it's time to hit the gas, which is kind of, I include that in risk management as well, knowing when to hit the gas. I will go up to 75 basis points or 100 basis points and include leverage, meaning for me, which is options and sometimes margin. So that's kind of the nuts and bolts of how I handle the basics of risk management.
I love it. That's great. Now, could you, do you know what that app is for sizing by any chance?
I don't. So quite honestly, it's a follower of mine that says it to me, and I don't know what the app is. But so I can tweet it out.
That'd be great. Whenever.
Yeah.
That'd be great for everyone. I think that's interesting. I didn't know there was an app for sizing. I end up just doing the calculations in my head. And so that would be really awesome. And
good for you
definitely
to be able to do it in your head.
well, trust me, it's not that accurate. Okay. It's just like a big ballpark roundabout amount. Okay. That's about it. But yeah, I love the 50, the 25, 75. That's awesome. And we'll talk more about that later, but let's go to Jack. Jack, tell us about your whole position sizing and set stops and so forth.
Sure. So actually, Matt and I do things in a very similar way. To be honest, because I like to risk roughly about 0.5% or so of my account, no more than that on any position. So in general, my 10% is my initial position, and I buy all at once. I don't. I know some people will layer into positions, but I don't. I usually will buy all at once, and then I may add to it or sell to strength later. But yeah, about 10% is my position, and generally, I'm going ahead and I'm going to be buying when a stock is very close to its 9-day EMA. I like to use a 9-day EMA, and from my studies and what I've done, usually the distance between the 9-day and the 23-day is usually around 5% when I do my best and on my buy. So they're relatively close. And then I use the rising 23-day as my stop. So my stop every day will get moved up, and I'm starting to de-risk the trade as the 23 goes up. So if I have a 10% position and a max of 5%, usually it's about 5% on the stop, then it's about that 0.5% that I'm looking for in order to my total account value. And so that is the system that I've come up with for me that works for me, and it's been pretty successful because most of the time in those situations, because unless the thing totally falls apart, that same day or the next day after I buy, usually I'm de-risking the trade literally immediately almost. And so I like that. I like to to go ahead and get into a profitable position as quickly as possible, whether it's that same day or within a day or two later. But getting into that profitable position is just so important. But that's basically in a nutshell. Half percent total account value, and I like the rising 23-day EMA as my stop level.
I love that. That's fantastic. You guys are very precise. So much to learn from both of you. I'm a scaler. I scale in and out of positions. I also am someone like you both said, and Matt mentioned it, how if it goes against you right away, like you said, a stop below the low of the day, that's really important to me. Like when I first get into a position, I don't want to have it go against me. And that's like right away. Like if it goes against me and maybe I just made a bad call on a wrong day, I was wrong, because it happens all the time. We all make mistakes. And I will get out quickly before, and it might even be just like 2% or 3%, whatever, it doesn't matter. I just want to get out. I'm just like, you know what? It didn't work it didn't work for me. It's just not my day or whatever. So I get out quickly. And because, especially in this market, once it goes below that, it can keep going lower. So I've been very cautious lately with that. Now with scaling in, I do anywhere from 25 to 50 basis points. So it depends on the time frame, and it depends on the stock, the type of stock. Like biotechs are different than like some tech, than some other. If a stock is very fundamentally sound, let's say like SMCI, everyone's heard me say this stock every day, I know, but let's just say that one as an example. It's always on my mind. It's easy to talk about. So the fundamentals are great. So like something like that, it's a long-term hold for me. If I see it dip down, and I will keep building that position over time. I'm not adding today. It didn't really come down that much because I own it much lower. But if I'm on a long-term stock, I will build over time. And if I see it dip, I'll add and so forth. So on swings, I do either a quick get out, or I will add like 25, maybe 30% to 50. And then I will consider adding a little more at some point, maybe. But in this market, I've been very cautious, so I don't really do that. So scaling is what I do in all markets. Time frames are really important. Knowing how long you want to be in your trade. If it's something, I mean, don't have your day trade turn into a long-term holding. I mean, that's like something people talk about, but it's true. You need to know your time frames. If it goes against you, you need to get out before it gets worse. And reduce position sizing, I find that very important, especially in this market. I just like to work with less. So I'm actually just working with less than I normally do. It helps reduce the risk and helps take the emotion out of the trade. And then, very important, I want to say, I establish these stops, the position size, everything before I enter the trade. Because once you're in the trade, your emotions take over. No matter what anyone says, when you're in it and you see that thing moving, you get emotional. And, it's important to just follow your rules. I'm a rule breaker. Sometimes I can be. I think we all are, but you have to follow the rules. And like Matt said, maybe it'll bounce off of your stop, but next time you're gonna save yourself that 30%. So it works both ways. If you don't honor your rule now, you're not going to honor it another time when you really need it. So you have to be consistent, and you have to stay with your trading plan. And that's very important, is consistency and patience as well. And my stops also based off of pivot points and supports, not just standard percentage of 15% or 10% or 8, whatever, it all depends on the chart and the particular stock. So it really depends on a lot of different things, but I definitely look at support is very important, and options are different, and we'll talk about that later. So I think I touched up on a bunch of stuff, but so how do you manage the risk in your trade, and what factors help you determine when to be more aggressive and when to be more defensive, Matt?
Yeah, so for me, it's all about my account feedback, actually. So I'm not one of these people that will kind of try to reduce their trading to an algorithm, essentially. I like to be systematic about certain things, and risk management. There's risk management rules that I'm, absolutely, that are inviolate. Like I will never cancel a stop, etc. I always enter a trade with a stop is placed. The trade is always pre-planned, like you had just mentioned. I'll never just wing it. The sizing is set up. All that stuff is just inviolate. But there are circumstances where intuition is going to be involved and seat time is going to be involved. And so I don't have a decision-making tree for absolutely everything. But what I do key on is my account feedback when I'm gauging whether or not to be aggressive or defensive. And what I mean by that is over 20 years, I've established kind of a bread and butter stable of how I'm going to operate, what setups I'm going to take. And they're really not that complicated, right? Like a lot of new people really love to focus on setups like there's some magic mystery there. And if I could just refine the way I enter here or refine the way I exit there, it's gonna be the holy grail. And setups are pretty clear. They're pretty cut and dry, in my opinion. It could take you, a short amount of time to really get your hand around the psychology of a setup and what type of setup you're using and how to enter and how to exit, et cetera. What can be harder is establishing a clear and consistent logic with that. And what I mean by that is, are you somebody who's taking pullbacks? Are you buying breakouts above pivots? Is there a clear and consistent logic to your actual trading? And if so, then you've already established basically the best indicator, in my opinion. Because if you have a consistent logic in your trading, if that suddenly doesn't work, that means it's not the right environment. It's not like you've suddenly forgotten how to execute or you just screwed everything up. I mean, if you're following your plan and you set the trade parameters ahead of time and you follow your plan and you execute, you're not reacting on just pure emotion. You have a logical plan. Then your best indicator is your own account success. Your whether or not those setups are working or not. And a great example of this is just it's an exercise in just beating your head against the wall since really February of 2021, honestly, to buy breakouts, just straight and simple breakouts. They have been failing left and right, right? So if you're that type of trader, you have to adjust or you have to understand that you're not in the right environment. And that's the feedback I get. If I have 4 or 5 trades in a row that go against me, and it's not because of a mistake I made, if I look back on it and say I would have taken this trade, 10 times out of 10, the reasoning was sound, the execution was sound, it just didn't work. That means it's not the right environment to me, right? So if I have 4, 5, 6 trades like that in a row that get me stopped out, or if I just have 6 trades on, for instance, 5 or 6 trades on, and they all get stopped out, that tells me I have to pull back, I have to take a break. That tells me to become defensive. Now, the corollary to that is if I've got 4 or 5 trades on and they're all really working, I'm getting a lot of follow through, lots of traction, they're all getting de-risked, and I'm taking partials really quickly, that means I can size up and get aggressive. So for me, it's the feedback that I get. But where that really breaks down is if you're a person who moves from strategy to strategy to strategy, because then because your strategy is largely random and not consistent and not consistently logical, because you're moving from one strategy to strategy, your feedback is going to be random as well. So you can't really do that. And this is one of the main things I talk about with people all the time, is that I think it's really helpful to get to a point where you're specializing and you're consistent in your trading logic, because then the best feedback of all is your account. And I really use that primarily more than any other indicator. I mean, there's no like sentiment indicator, there's no index indication, there's certainly no actual price oscillator or indicator out there that is going to tell me when to get aggressive and when to get defensive. I will use things as tools, but the ultimate indicator for me is my actual account.
I love that. That's excellent. I mean, what better gauge of how you're doing than your own account? It's all about you. It's about your account. It's about knowing yourself, staying consistent, and your account, your portfolio talks to you, and you're able to understand, and you're accountable, and it's great. I love that. Jack, tell us about you.
All right, so I agree with Matt 100%. Ultimately, your account, successful trades versus unsuccessful trades, that will give you the feedback you need. But I do go a little bit in a different path, because every week I try to find, the story of the market, right? I try to reset everything once a week on Saturdays and just really look at what the story of the market is. And so some of the things that I want to look at is I'll look at the indexes, right? All the indexes, and then I'll look at them versus equal weight counterparts, right? Gives me a feeling of what has breadth been like for the week. Are we seeing this a broad-based move? up or down versus, a cap weighted move. And I think there's a lot of information there as far as kind of what's going on under the surface of the market. I like to look at some key sector ETFs, things like the financials and semiconductors, transports, home builders, right? It gives me a feeling of kind of like what's going on in some ways in the economy, right? Because that pretty much checks off most of our economy right there in those four sectors. I like to look at the internals. I want to see what bonds are doing and bond spreads are doing. I want to see what the VIX is doing. I want to see are we in a trending market? Or are we in a more volatile market? I want to see what the dollar is doing in the 10-year yield, because again, they will influence, where people are positioning their money. And I like to look at the put call ratio, equity only put call ratio, because I want to see how everyone is positioned. So there's a lot in there, but each one gives me a data point, a piece of information. And overall, if I can put them all together, appropriately, it's going to tell me the story of the market, right? Obviously, I also look at breadth indicators too. So again, looking for extremes, right? Extreme in breadth when we're improving breadth, all that stuff is, again, it tells me what is going on under the surface. And then I kind of have a feeling of, okay, are we in a risk on or risk off environment? And that is the whole point of going through that process, is to figure out what type of environment are we in, because that is the most important first step, because if we're in a risk on environment, then we know we can go ahead and obviously put our own money to work, and maybe even and be a little bit more aggressive. And if we're seeing we're in a risk off environment, well then cash is a great position, and we can tighten up stops if we're in positions, and we can even look at shorts potentially if we're in a risk off environment. And so it's a really important a part of my process is to go through those pieces and really get a feeling of what's going in the market before I even look at any charts or setups or anything else. So that's that. Now, of course, obviously, if trades aren't working, that's a huge piece of the puzzle too, right? If that's the feedback we're looking for. I'll give you a quick little story. So I have a super follow group, and we were in AEHR, right? And we had our stop set, and I was looking at the price action yesterday and what was going on in the markets, and I cut the position, right? And I tweet out to everybody, hey, listen, just so y'all know, I cut my position in AEHR because, I don't like the price action. And somebody DM'd me and said, hey, but you said the stop was here and we haven't hit it yet. And sometimes it's okay. Listen, I see what's going on. I see the market really turning, and I don't know if it's going to go much lower or not. But my intuition is telling me that this isn't the place that I want to be long, and I'd much rather be out and wish I was in than in and wish I was out. Now, this particular time, it worked out in my favor, right? It's down 11.5% today, that particular name. And then there's reasons. It was coming up against a long-term, uh, resistance area and so on and so forth. But the point is sometimes that intuition would be like, you know what? It hasn't hit my stop yet, but it's not acting right. The price action isn't right, and I just want to cut the position, and I need to reset it, watch it again, and if it sets up to my liking again, I can then jump back in it. And that is actually one of the hardest lessons for me to learn in the market, was to be able to re-enter a trade after I recently got stopped out or cut it myself, and it sets up again, and I'm able to reset it in a short period of time. So that's kind of how I tell.
I love it. You both covered great perspectives. And thank you so much, Jack, for mentioning that entire the market, the sectors. I actually do a blend of both of you guys. My focus is always my positions. It's my account, my portfolio, and I'm always focused on reducing the length of the feedback loop. It's all about trial and error. It's about reducing that feedback loop and knowing what works. So I always keep a close watch on my positions. And then, of course, I always look at the macro And, I'm being in the business world myself, I'm always involved with all the economic side of it, and I understand how all that works. So I keep an eye on that. And, we know we're in a rising rate environment. So we know that the ERP, the equity risk premium, is affected. That means yields need to go up for SPX. So prices and valuations come down, all that kind of thinking. So we already know it's more of a risk off environment, except for these bear market rallies. So, I keep that in mind. I have sentiment, option flow I look at as well, charts, fundamentals. I have a whole investing puzzle. So I look at everything. It's very important. But ultimately, like Matt said, I'm so focused on my positions. So to me, it's been a selective stock market throughout the year. I mean, overall, tech is taking a dive, but then you have quite a few of those that have held up pretty well. I mean, overall, cybersecurity has held up well, but then it's still selective in there. I mean, Fortinet, which is a long holding of mine, hasn't done as well. I think it's a great company. So it's been very selective. So I'm always focused on my stocks. But then if I see my stocks aren't performing well, which is the feedback like Matt mentioned, I'm like, oh, my stocks aren't doing well. What's going on? Then I really focus on the market. Is it the market? Is it the sector? Or is it just my position? Is it just my stock? So you always ask yourself all these questions. So that's why it's important to look at everything. It's a holistic kind of trading. You look at everything. And, you look at sector rotation, you look at the hot sectors. Bar chart has a great place where it says hot sectors. So I look at that. I look at the indexes, the moving average, see where the indexes are regarding the moving average. We know Dow Jones has held up much better. The Dow has been the strongest one. I mean, that's the value, because SPV has been performing better than SPY SPY value is performing better than SPY growth. We all know that people are going to cash value. We want fundamentals matter. We want stocks that have better value. So we want cash. Cash is important in a rising rate environment where rise of cost and debt and capital is rising. We want cash. Free cash flow matters. So more than ever. So there's so many different factors. I want to mention, I sometimes utilize very simple. I don't go complex with this, but risk-adjusted returns are very important to me. It's like Matt said, and both of you said, how risk is like a state of mind. You enter the trade. I enter business decisions. I enter any decision I make looking at the risk involved. Is it worth it to me? Cost benefit analysis. Is the reward worth the amount I can lose? And those are it's like a balance. You have to adjust for that. So in this environment, you need to get a better price for the amount of risk you have to take on, because now, real rates are positive again, and they usually are, but it just came positive again in April or May this year. So now, it's we're gonna have to get a better value to take on risk. So the times have changed a little bit. So to me, I'm not aggressive in this environment overall. I've definitely reduced my position sizes. I mean, I was pretty aggressive in 2020 and other times when we had runs throughout. I mean, I've been trading now since like 2000 on and off. I mean, I haven't been full-time trading, but I've been trading, and I'm a long-term investor. So it's like there are different time periods. This is not a market where I'm aggressive. And I'm not someone who aggressively shorts either. I do have hedge. We're going to get to that. I do a little bit, but I'm not aggressive. I rather just, scale back, reduce position sizes, and overall, I'm more defensive. So overall, during this time period, I would say I'm just defensive. If I see a stock getting ready to break out, it's a bear market. So I think the breakout's going to fail. So I'm usually a breakout kind of person. I do like to buy breakouts, but I'm not really. And that's not really what I'm doing right now. That doesn't really, I mean, it could work, but I'm not banking on that. So I'm not staying with that strategy, and so I assess myself. I know what works for me. And I know that kind of strategy doesn't really work in this environment. So I'm not utilizing that strategy. So I'm just using different types of strategies with risk number one, always assessing how much I can lose, because it's not about what you make, it's about what you keep, your net. So just remember that. So I want to ask you guys, when do you step back entirely and take a break and trade less? Is there a certain signal? Is there something that you see that happens? Matt, could you begin with that?
Yeah, I just missed like almost everything you guys said for the last few minutes because I got kicked off. So I'm sure it was brilliant from both of you. Um, but let's see. I think still for me, the most important thing for when I'm going to take a step back is again account feedback. And I agree 100% with what Jack was saying about how you have to go through a process of figuring out what's going on in the market. And I'm definitely looking at the indices and key ETFs and looking at where things are on a technical basis. I'll look at the weekly charts and look at where we are in relation to Stan Weinstein's 30 week SMA and all of that, and keeping field position in mind. And I'm always trying to focus on the leaders in the market, so the leading sectors and leading industries. But I will take a step back, certainly, when I just feel like I'm beating my head against the wall. And that has been a huge portion of this year, quite honestly. I've gone weeks where I've done absolutely nothing. And literally, like, I'll make a dentist appointment to keep myself from looking at the market, because it's been that type of year. So I think for me, again, once again, knowing that we're in a downtrend, knowing that we're in an overall downtrend is obviously the simplest thing to figure out, right? A simple downtrend line, the definition of a downtrend line is that it's illustrating to you lower highs, right? So as long as we are in an overall downtrend, I already know that I should be going much less aggressive than I usually do. And the probabilities of long trades are simply lower, right? So it's always a probabilities game. So even when I'm trading my best, I'm 50-50. I have a 50% batting average, meaning the only way this makes sense, right, is if my average winners are bigger than my average losers, because I'm going to be wrong 50% of the time. That's why I always think that, it's unbelievable when people have a massive ego in trading, because anyone who is really actually a consistent trader knows that you're going to be wrong roughly half the time. And it's hard to have a massive ego when you're wrong half the time. What you're trying to do is make your winners pay and cut your losers really fast. And I did hear you guys talking about cutting losers quickly. And this year, literally the only reason I'm profitable this year, and I went back and looked at my journal, is because since the average winners are smaller, like I'm getting 1.5 R, I would do everything by a multiple of R, an R multiple. Since I'm not getting winners that run out, right? This is not your market to let your winners run. This is not a market to get 10 R winners. I'm getting 1.5, 2 R, like base hits. So the only way to make the math make sense is to cut the losers before they hit your stop. So I've been mercilessly cutting losers. Basically, as soon as they go against me, I cut them. So long story short, I think is that I will trade much less in a market environment where I know the probabilities are lower. I mean, we're in an environment now where your probabilities of success to the long side are just lower than they usually are, right? And you have to come to terms with that. And people will see, sure, there's a stock that moved 15% in the last couple of days. There's always going to be a stock that moved 15% in the last couple of days. It's a needle in the haystack type of thing at this moment. I just got an alert. The Dow is down 500 points. It's hysterical to get alerts from CNBC. In any case, I think that what I do to take a step back is when I know that my probabilities are lower than they usually are. When I know we're in a very poor environment, that's when I take a step back. And one way that I am systematic about knowing that there's a poor environment is average true range of stocks and ETFs will increase dramatically. And I'm not talking about the VIX, which is obviously an indicator of the implied volatility on the S&P 500. Options change, but in terms of average true range on individual stocks and ETFs, you will see a massive ramp in the average true range. And it's really the visual way to see it is if you just look at a simple chart like the Qs, after January 2022, you're going to see candles that are much wider, much looser, gaps all over the place. If you go to the left side of January 2022, you're going to see candles that are much tighter, much fewer gaps. And there's just much less volatility. And you can pick that up on average true range. If you put average true range on your chart, you'll see that average true range really shoots higher during these volatile bear markets. And for me, when that is the case, when there is a lot of intraday volatility, that is the hallmark of a bear market for me, and is a very poor environment for me to trade my strategy, which is swing trading, because I rely on follow through. I rely on not having intraday violent reversals. So I just know from that simple fact that it's a really tough environment for me to swing for me to swing trade in. And for position trading, when we're in downtrend, I don't position trade to the short side. So if we're in a downtrend, I'm not position trading to the long side. So I haven't position traded all year to the long side. I want to be in a confirmed uptrend to catch the meat of a trend. That's how I position trade. So long story short, when there is increased volatility, when I can see gaps all over the place, when we are in a headline-driven market like we are, I will trade less because of those reasons, right? We are in a headline-driven market like I have not seen in a very long time. We're jumping from Fed speaker to Fed speaker, CPI number to CPI number. All of that risk is something that you just can't take into consideration when you're swing trading, because it increases that intraday reversal, that intraday volatility that is out there. So it's an extraordinarily difficult swing trading environment. So kind of all those factors add up to make me much less active. I've traded less than 50% my total trades that I normally do, and size smaller. And where I might have 5, 6, even 8 trades on, some with leverage, sometimes even more than 8 in a roaring bull market. In 2020, I would have 10 on, no problem, and several of them would be leveraged. In this market, I honestly have 1 or 2 at most, and I'm watching them like a hawk, and I'm out of them almost immediately if they go against me. So that's the kind of the combination of things that is adding up to me sitting on the sidelines more often this year.
I love it. It's funny, Jack, can you confirm? I basically said a lot of those things. Yeah, right? Matt, are you sure you didn't hear me? Well, anyways.
I'm sure it's user error, but I got kicked off twice and could not.
You subconsciously heard me, because I said, overall, this market, I've been defensive. And that was the whole point of what I was saying was I'm a breakout kind of person. I like that. And I was so aggressive in 2020 to up to 21. And then this market overall, I've just been defensive, reduced position sizing, and little bit of shorts here and there, but that's not me. And I'm not for a choppy market like this. This isn't how I trade. This isn't my style. So it's probably great for a lot of people, just not for me. So, but I said basically similar stuff. And so that's awesome. I agree. I love all your input.
I think what this market does is it compresses your time frame because there's no follow through, right? So that's
exactly
day traders market. That intraday volatility, that increase in volatility, that increase in ATR, that day traders love that.
Yes, I know.
I'm having a great time. So
exactly, as swing traders, it's so out. Like 22 is not a swing trader market at all, because it's like and like exactly what you said. You cut those losers quick, and that's what I've been doing in this market. While it's like the opposite of 2020. And it's great just to make note of this. Then I would hold, and I'd even average down. I'd add more, because you were in an uptrend. So it's like the opposite here. I cut quick. If it goes against me, I'm cutting quick. And then my winners, if it's a swing, if it's a shorter term position, not a long hold, yeah, I'll take my profits. I'm not going to sit there and hold and hope it's going to keep going, like you said, 10R. It's not. It's not that kind of a market. So exactly, agree.
Really quickly, that this is such an important concept, particularly for newer traders, that how important the environment is.
Yes.
It's not a reflection of, your strategy doesn't work anymore, right? You're not in the right environment. But I think there are, I see it. I see it because I interact with a lot of traders, right? And there's a lot of new traders out there that are just perpetually banging their head against the wall and thinking that they're doing something wrong. How could I have fixed this? How could I have changed my entry? How could I have changed my stop placement? The reality is that the market environment is against you right now. If you're trading to the long side, it is simply against you, period. You can have a perfect setup that makes perfect sense, and you take it, and the odds of it working are simply lower than they would be in a bull market. It's as simple as that. But I think a lot of people, especially new traders, just think that, I'm going to call myself a trader, so I should be able to take money out of the market like an ATM machine every day. And they're not taking into account the power of the environment. And when you are simply up against a poor environment, and you have to understand when that is, otherwise you deplete your financial capital, your mental capital, you destroy your confidence, all of that.
Agree. Excellent point. Thank you so much. Jack, I know you're probably dying to jump into this discussion, so please tell us your thoughts.
I'm enjoying listening to Matt talk, man. He's awesome, and I agree with like everything. I'm like, you should see me nodding, talking, right? I'm like, yes. You know what? I've been 50% or less invested for most of this year. It's just because the market, again, when price is under a declining 200-day moving average, the market is going to be suspect. That's as the simplest trend following that we can do. Price under a declining 200-day moving average, you have to assume the bearish scenario is most likely going to happen. We may get these rallies, which we've seen, but the bearish scenario is going to happen. It's and something that Matt spoke of and that I really look for is that tight price action versus wide and loose price action. And it's something I've been actually trying to really focus in on, especially outside days. Because outside days to me is an increased volatility type bar, right? So that tells me that there's a wide ranging bar almost always, and it's increased volatility. And I've really been focusing on those. And when we see those really start to appear, it's usually the end of a run. Always a downtrend. It's the end of that trend rally, usually moving average, something like that. You see that move, and boom, the market kind of falls apart. So I've been really trying to focus on those outside bars. Really notice. It's something new that I'm kind of adding to my process, but it's giving me a lot of information. But yeah, I've been less active, and again, it's the feedback from the market, right? I mean, just up until the end of last week, I was like, okay, we have some indexes that are getting over the 200-day. The mid caps were looking really good. Small caps were kind of coming back a little bit, and things were starting to shape up. If we have a couple more weeks of this, the 200 may actually start to flatten out with price above it. That'd be kind of nice, and I could see the bull scenario in there. And that's what I wanted to see because I'm relatively an optimistic person, and the markets are built to go up over time. So that would make sense as well. Those perma bears, they're going to get their butts handed to them eventually because the market's built to go up, and eventually it will again. But you know, as soon as those wide and loose bars started to really start to show up, you get what happened this week so far, which so far has been pretty negative price action, losing those 200-day moving averages, which are still declining, and and it's pretty rough. And then, talking about the IWM, that's got a pretty decent looking head and shoulders pattern that it's been trying to complete. It's been one of those things where, since May, if you look at it, and I'll see if I could pin this into the nest because I've been really watching this. I was thinking for a while it was gonna not happen, but it may. It still has to confirm. There's still, but it's lost its trend line. It's lost the 200-day moving average, and it may be trying to I'd say top again because it's been in a downtrend, but it's been but it makes me very nervous the way that IWM is acting right now. But that's another topic.
I just looked at it myself. I see it's just breaking right through the VWAP at 180. So yeah, I'm looking at the IWM, the SPY as well. And we'll have to see how the DIA responds after today. We have CPI next week, Fed meeting, could be preparing for that. We'll have to see. In my opinion, I am neutral person. I'm very positive for sure. But I'm looking at this market from a neutral point of view. I see the macro is very bearish, and rising rates are incoming. Doesn't look like it looks like they're maybe slowing down. Maybe December. I don't know. I'm not going to hypothesize about that. But in a rising rate environment, it's not favorable for equities. We know that. So I'm about 50% cash. Anywhere between 45 to 55. I rotate within that window. If I see myself getting too invested, then I have to sell something or I have to pull back on something because I need to maintain my trading rules, like we said. So you have to maintain consistency and you have to follow your rules. So I try to keep within that window. Overall, I'm defensive. I'm staying more, at least 50% cash, and and that's just the way I've been in this market. I don't trust this market, in my opinion. This is probably a bear market rally, or it was. And Until it proves to me otherwise, I'm just going to be very cautious. And so that's my thinking with this. Acknowledging, being accountable. We discussed this before. It's not about being right or wrong. It's about making money. So it's better to just be self-aware and accountable for your actions. And if something's not working, then stop doing it. And it doesn't matter. It's better to be, commit that you make a mistake and so you save yourself some losses. Mindset is very important. And I was going to touch upon this later on in the emotional section that we're going to get to, but I just want to mention it here. It's about your mindset. And if you're upset from a loss or you're too elated from a win, I think it's important to take a break too, because we're all human and, we can get emotional after a trade. And if you take a bad loss, you get upset, you want to just go back and you're like, I just got to win it back. I just got to get it back. And it happens to people. So just, that's another time to take a break and trade less, is when you feel that you have some emotions. Because it's important that you enter into a new trade neutral. You can't get rid of your emotions, but you can minimize them. And at least don't bring the baggage from your previous trade into your next trade. Treat every trade as independent. So that's really important. And market awareness, like we just said, the macro, looking at the indexes. You don't have to know the macro. You don't have to get into all the economics. You can just look at the charts. You guys are amazing with the charts. Look at the indexes, the sectors, exactly what Jack said. And where things are going. You can sense that. You can see that on the chart. So overall, to me, it's risk off. And I've been acting accordingly that way. And I've been doing it through options a lot. And I will discuss that a little later on. But always to acknowledge when your plans don't work, step back, reassess what you're doing wrong, figure out the problem so you don't keep repeating it. It's important to learn from your mistakes. Then it's not really a loss, right? Then you'll prevent yourself from making it again. So just try to have a positive mindset. And it's a tough year for everyone, not just you. Don't give up. Don't think it's your strategy. It's the market's working against you, like Matt said. And that's the key here. So maybe you just need to not trade as much. I know maybe you want to be full-time trader, but maybe this just isn't for you. Maybe it's just not your strategy. Maybe you need to learn a little different strategy. I don't know what it is, but don't beat yourself up for it, because it's a tough market for all. So just want to throw that in there, because I think that will help. Okay, so what changes or adjustments have you made in this current environment? I think we touched upon it, but let's go deeper into it. Matt, can we begin with you?
Sure. Yeah, I think I started touching upon what I've been doing this year differently, and that's basically it comes with recognizing the environment we're in, right? So if we're not in an environment where let your winners run is the mantra, right? And for me that's a bull market, clearly, right? Because I'm gonna swing trade and position trade most successfully to the long side, because that's my strategy. I'm always looking for strength. I do short, but never for very long at all. I certainly don't position trade short. So for me, I'm always looking to let a winner run to the long side. There's no way I want to let a winner run to the short side. For me, I know some people do that, but I don't do it. I don't operate that way. So knowing that I'm in an environment where I'm not going to let my winners run, I change my expectations, and I have this way of thinking of it, which I just call expectation alignment, which is just basically like having your expectations make sense with reality, right? So you want to align your expectations with the environment that you're in and with reality. I'm all for having lofty goals, having the achievements that you're trying to reach for, and really trying to stretch yourself and achieve things that you might not think you can achieve. But there has to be a point where you're grounded in reality to a certain extent, right? And I think that personally, especially on Twitter, I think that the understanding that compounding your account successfully year in and year out is a very powerful thing has been supplanted by the urge to 3x your account every year, every half a year, to have these just ridiculous triple digit gains constantly. And I think a lot of that came from 2020. I mean, I had really good gains in 2020, there's no doubt. And I did not expect that to happen again because that's not the way that the market normally operates, right? You don't just get high triple digit gains thrown at you every year. But I think that a lot of people focus on that unrealistic goal, at least in terms of consistency, of 3xing, 4xing, 5xing your account every single year. And their expectations are not in alignment. And in a market like this, I think having your expectations in alignment. And first of all, what I mean by that is expectations for both your gains and your time frame. So for me, in a market like this, having my expectations in alignment with the current market means I don't expect trades to last. I expect a swing trade to last a day, 2, 3 days. That's what my average swing trade length has been this year. That short, right? Which you can barely call swing trading, honestly, in my opinion. It's like a little bit. It's one night's sleep beyond day trading, right? But that's the expectation of duration, and then the expectation of gains, where I would normally, and I touched on this earlier, I would normally be looking for 3R, 4R, 5R, or more. If I'm going to let your winners run market, I'm not looking for 1.5R. You got to take your money quickly. I take partials quickly. I'm taking bigger partials. If it's in your account, pay yourself. I mean, that's the kind of expectation alignment that I have happening differently in this market, and where I see people, to be doing what I consider to be a mistake. Is people may understand they're in this environment, but they're still trading as if they're not. They may get in a position and it starts working, and then they think, oh, we're probably in a new bull market now. I'm seeing some people tweet that we're in a new bull market. We're probably in a new bull market. So I'm going to let this thing run. I'm going to beat myself up if I bought in at this level and it runs for the next 3 months. And then what happens is it turns right around, takes them out at break even or worse, because they haven't raised or stopped at break even. It turns into a loss. So I see a ton of that happening. I work with people that are doing that. I see a ton of that happening. And to me, that's a misalignment of your expectations that's not coinciding with the reality of what's out there, right? So that's a change I make, is getting my expectations aligned with the actual market that is out there. And another thing that I do is I just simply don't trade leverage. I have not traded leverage this year. And I think that may be something we were going to touch on later, but I'm just bringing it up now because that is a change I've made, because I typically am somebody that trades options. I will trade options. I have kind of different strategies for it, but I will trade options. I could probably count on one hand the amount of options trades I've placed in 2022. And that is definitely different for me because I don't want the volatility in my account. I personally don't want to swing trade options when the VIX is elevated. It's not elevated right now per se, but when the VIX is above 25 and 30 range, I don't want to be trading options, and I don't want the volatility in my account. I want to be able to really, really precisely manage risk and trade small here. So that's one of the other changes I've had. So I would say, really understanding the environment we're in and not expecting miracles, because it can be really detrimental. I see a lot of people that really beat themselves up and they think they're doing something wrong in this environment. And the reality is this is a tough environment. This is a really tough environment. I did an interview with Oliver. I think he's on here. I see his face on here. Just recently on YouTube, we were talking about the USIC, and I think there's a lot of really good things about that, and a lot of like life, there's some harm that's done by that. I think overall the USIC is a great thing, but I think that in this market you see somebody who's up 400%, some people that are up 100%, and people think that's what you should be doing. Those are definitely outliers in a market like this. And if you're somebody who is just breaking even this year, you're doing a good job. And I don't think enough people hear that. And the only way you're honestly breaking even this year is if you have a really good risk management system. And I'll end this little segment with thinking of the memes that I actually sent out there too, where you have a cartoon of two like ticket booths, right? And there's one side of the ticket, one side of the meme has 100 people in line, and the other side has none. And there's a sign above the ticket booths. And I tweeted something, I don't know, a year and a half ago, where the one with the crowds had, the Lotto Fridays, the rocket emojis, the YOLO trades, and then the line with nobody in it at all is risk management. And I think the irony is, that was the atmosphere in 2020, and now, I think you could change that to be where the YOLO trades and the rocket emojis. There's nobody in that line anymore because they're not participating in the market right now, quite honestly, because a lot of them blew up and could not manage their accounts to account for the risk involved. And then the only people that are left are the people that actually focus on risk management. So, keying right back on risk management, I think it's so important, especially in this environment, because that's your safety net. It's the thing that's going to keep you in the game, and it's the thing that's going to keep you operating when we do reach the other side of this, whenever that is, right? And we're in another bull market. The only thing that's going to keep you in the game is your risk management right now. So things that I'm doing differently are just really, really paying attention to risk management day in and day out. I would say I do that usually. But in a market like this, you have to be really tight with risk. Total open risk. Total open risk is something I talk about all the time. And it's just the amount of total open risk you have on at one time, meaning if you get stopped out at one point, how much is your drawdown? And I try to keep that really, really, really low. So in a market like this, at any given time, if I'm taking 225 basis point trades, I may only have half a percentage of my account at risk at one time, which is not going to leave a mark. So that's the kind of way I've changed my expectations to align with the reality we're in.
I love it. Thank you so much. And it's exactly what the space is called. It's a no fantasy zone, because, these 100% gains and then these other people who seem to flash it on Twitter or other social media, it's try to ignore the noise and just focus on yourself. I know it's easier said than done, but that can lead to fear of missing out and that'll cause you to lose in this market. It could. I mean, it's a tough market, like you said, and less is more. If you need to have your expectations in alignment with the actual, and that's so true. This is a different market than 2020, and there have been other markets in history that have been good and some have been worse, but this is the recent history. So it's a great way to compare. They're like polar opposites. So it's a great comparison. So yeah, not losing or being even is definitely a great accomplishment. Because then I start thinking, well, it's what it costs you. If I worked to make that trade just to break even, then maybe doing less is more. So if I trade less, and I know, Matt, you've been overall trading less this year, I think that's so smart because in the end, it's about what you keep, and it's not only your money, but your time. So great stuff. Great stuff. Jack, can't wait to hear you.
After Matt, come on, man. He was awesome. I think the one thing that he said, and I know our friend Sunrise Trader says this all the time too, is no green to red trades, right? So I think that's what I've really focused on as part of my risk management this year, is that once a trade is in a more profitable position or a profitable position and it's green, all right, on my P&L, I won't let that trade get to red, right? So it has to get cut because this is not a market to be trifled with. It's not one that's going to be forgiving, right? In a bull market forgives you. A bull market is like you get a sloppy entry, you're probably still going to make money. If you have a wider stop, you're probably going to make money. Well, that's not what we have today. And so I guess realizing the market that we're in, which goes back to what we were talking about earlier, is realizing the market we're in, right? That's always got to be the first step in what we do, I believe, as traders, is determine the market that we're in. And then once you do that, you have to adjust your risk parameters to that. If you catch a counter trend rally, you could get a week or 2 weeks of some sort of bull run, but that's been it as far as we've seen so far in this bear market. Is a few weeks of maybe some good bullish price action, and then things tend to get rejected again, and so we have to kind of keep our expectations aligned with that. And then again, it goes into the feedback, right? So now, okay, I've had 2 or 3 stops that have hit within the last 2 or 3 days or more, or maybe now I was 50% invested and all of a sudden I have one position on, right? That's feedback the market's giving us to take a step back, keep staying cash, right? I'm a big proponent of, if the market's giving me the message of the feedback, of stopping me out, well, then why would I want to plow back into another name immediately? My best bet is to do nothing, right? Do nothing, watch what's going on, watch the price action. And then if and when things get good again, then we start looking for the relative strength and everything else. And again, and recently, as things were doing really well the last couple of weeks in the market, one of the things that was making me really nervous were the areas of the market that was doing well. It was industrials, and it was materials, and it was healthcare, financials a little bit too. And so it wasn't your normal growth bull market type areas that were leading the market up. And so that in and of itself was something that was keeping me very cautious as the market was moving higher, or trying to move higher. And it turns out, as of today, pull back today. So we'll see what happens. But you want to see the risk on sectors leading the market, I think that's a good tell also on what's going on. And we just weren't seeing that over the last month or two. We were seeing more defensive type areas of the market leading, and that's information as well. Yeah, and I guess that's the thing. It's feedback from the market, and then stay in cash when it gives you that feedback. Don't plow back into more names, thinking that that you always have to be trading, you always have to be investing. It's okay to be in cash for a little bit. You know, the best part, I feel like the best part when you've really got a handle or a better handle on trading is when it's calmness. You get stopped out, and it's calmness. It's not even an emotion, right? And we talked about emotions a little bit, but it's calmness. It's okay. I got stopped out. It's calmness. Okay, I made a gain. It's moved my stop up, but it's calmness. It's not this like highs and lows of personal internal highs and lows and everything else. And that's when that eventually came for me, like it's so good. It's so peaceful, and that's great. And it's just a trade, and you realize it's just a trade. One trade isn't going to kill me. I mean, in my former or earlier trading self, I've at my JC Penney. I'll tell you my JC Penney story real fast. This was years and years ago when they were actually trading JC Penney and that didn't go bankrupt. But I bought JC Penney because I thought it was a company that's been around for 100 years. It's not going to, how could it be terrible? They're in every mall in the country basically. And so I bought some, and it was in a horrific downtrend, and it kept going down, and I would keep adding a little bit more, a little bit more, a little bit more, until a very large portion of it was a small account portion of my account was in this particular stock. And eventually I was down 50% of my trading account in this JC Penney stock, which was terrible. And thank God when I was trading very, very small at the time. And and I talked to a trader actually that I met through FinTwit, somebody that his name if I mentioned it. And I said, hey, here's my position, here's my situation, what should I do? And he said, sell, get out of it. Just you gotta rip the band-aid off and get out of the position. And I did that, and obviously saved the rest of that small account. But that was like the best advice ever, right? So sometimes if you're in a position and you're like, oh, but I love this company or I love this story, but the price action's going against you, you have to rip the band-aid off. Watch it, maybe it sets up again, but you have to rip the band-aid off. So I think that's an important thing to mention as well, and that's something that you only I could tell you about it, but until you go through it and you have to live it, that is that's how you learn, unfortunately, but that's the way it goes. So what you got, Rosanna?
Excellent. I love it. Thank you. Yeah, you just got to rip that Band-Aid off. It's like you can't keep kicking yourself that, oh, I should have done it before. I can't do it now and this and that. Because then as time goes on, that 30% down goes to 50% down. And then that 50 goes to 70. And it's like you just know that you just need to cut it. So that was a great story. JC Penney, wow. That was great. Thank you so much, Jack. And Matt, excellent too. Thank you so much for everything. And this, I'll add, I love everything. I agree with everything you guys said. So I'm going to add a little something different. I'm going to talk about options a little bit. I did say I like doing less overall in this market. Choppiness, it's like you lose both ways. It's not like you can actually have a position. Like Matt said, he likes to go long. I'm a long person too. 2020 was a great market. You don't even have to have 2020, just a nice bull market the way it's been for a while now. It was good. Some kind of uptrend. We've been in a downtrend. So I'm not a person who just holds on to a short position. Like Matt said, I'm not a positional short person. I do have shorts. I have SQQQ right now, and I see it's like up significantly green today. That means the market isn't doing so well. So, and that's the next section. We're going to talk about hedging, and I'll mention that. But regarding this, I don't buy breakouts in bear markets like I do in bull markets. I said that before. They're usually fake outs. I'm very cautious, and it's choppy. So both ways you get burned. So you just got to be careful. Reduce position sizing, to me, has been one of the tops. I cut my losses quickly, and I scale out of my gains. And I want to mention that too. I try to scale out and try to take my principal out as much as possible. Doesn't always work out, but I scale out in that way. I want to lower my risk on the trade. And if I really feel it's going to run, I want to make sure my risk is low. So if it doesn't work work for me, then I'm not losing as much. So otherwise, I just take my profit and I leave. I'm not greedy in this market, and a win is great. And breaking even is still good as long as you don't lose. It's that type of a market. So don't be so hard on yourself and just step back if you do get upset, and enter a trade calm, and do things in a calm manner. It's difficult to do, but you can work on it. With the higher VIX, which has been happening this year, it hasn't been as high as people predicted. They were saying 40s or 50, whatever they were saying. We tend to have a higher IV. So I've been doing more spreads to help reduce risk and lower cost basis. I prefer selling options. I'm more of an options writer than I am, a YOLO. I don't do YOLO or any of that stuff. In 2020, sure, I was guilty of it too. I think most people were who did options, did some kind of, fun long calls or something. But I did long calls then that were sound, but I also did YOLO. But anyways, in this market, I sell options. So I prefer selling covered calls against my shares. And I guess I'll cover that more in the hedging section. But if I do my swing trades, I'll do a bear call spread, or I'll do a bull put spread. Sometimes I just sell puts. Let's say a company drops down significantly. I did that with Palo Alto, like a month or two ago. I don't know, something like that. I did it with Snow. I've done it with a lot of different companies, and I've tweeted about them. But if it's a company I like already and it pulls back significantly, I'll sell puts on it. And there's different strategies after that. You can buy it back when it bounces up. You can hold on to it. If it goes in the money, you can always get shares put to you. There's different strategies there. But I do utilize that for my swing trading. I do a lot of options trading. So, and remember, options move fast too. So you got to be really careful with your risk management with options, which for me is different than shares. So I have a little more leeway with them, but you still have to be very cautious. So I tend to sell more. I do more spreads. If I go into a short position, let's say SQQQ, I have it in a spread. So I actually have it in, I think I have it a vertical or diagonal. I think this one's this one's a vertical. So I have it in a spread. So what I do is I buy the call and then I sell a higher strike call. So it helps lower my cost basis. So to me, that's a form of reducing my cost, reducing my risk a little bit. And so instead of just buying straight calls. So I prefer to do spreads more than I would have in the 2020 market. In the 2020 market, I was like, why should I even, even limit my top end? I was like, why should I sell a cover call? Sell a call against my long call, because it's going to run. So I would do a lot of long calls instead of doing a vertical spread. But in this market, if I want to buy something, let's say like a index short, which is for this example, I'm going to say the inverse call of SQQQ or SPXS, the SPY ETF, the inverse. I'll do it in a vertical spread or a diagonal or even a calendar, and that will help lower my cost basis and reduce my risk. So that's something I've been doing in this current environment, and that's been working for me. And let's say it goes against me, I can at least get out and I will save myself a little bit. It'll be, so it definitely reduces your risk. And so once again, I rarely just buy straight, long calls or anything like that in a downward trend. And if I do buy naked calls or puts, it will be on the short side, and it's short. Like, let's say if it looks like it's going to take a downturn or something, I'm trusting more like a fast downturn than I am an up. I mean, but we do have these bear market rallies, which are pretty violent and vicious. I mean, this was a great run what we had recently. But overall, just doing less, and I'm just giving ideas for things that I've done and I've been doing on and off. But, just got to proceed with caution. It will get better. This market will change and we'll be back to our, like Jack said, our upward trend, which is if you step back and you look at the bird's eye view, you see that SPX and Q, all of them, all the indexes all go up over time. So it doesn't mean to go long. It doesn't mean buy everything now because eventually it's going to go. It could take a while. But overall, just stay positive and it will change. It's just a tough market right now. So I think I've spoken enough about that. So, Matt, you talked about leverage and you say that you use leverage in 2020, but not in this market. What do you do to hedge? Do you hedge your portfolio at all in this market?
Yeah, so it's a good question, and I don't hedge. So I don't hedge, meaning I'm not trying to find something with a high correlation to move inversely with what I'm in. In fact, I actually think that in a lot of ways, when people do hedge that way, when they try to find, let's say you're trying to short a position or you're going an inverse ETF or something, you're trying to find a high correlation to a position you're in. Sometimes those correlations break in a bear market. And then you end up in two losing positions. So it's something I avoid. I definitely, and because I'm generally, especially in a market like this, trading really short term, really a few days is the average that I've had positions open this entire year. I'm just my hedge is cash, quite honestly. So and that's what my stops are going to do. They're going to protect me. They're going to put me in cash. That's my hedge, right? So I'm just going to get out of the trade and I'm going to be sent back to cash if things aren't working. And that's what I consider to be my hedge right now. There are times where, in my IRA, which I handle differently, definitely, and that's definitely position trading. I will do covered call type things. And I may hedge a position here and there with puts, but it's pretty rare, honestly. I try to go as simple as humanly possible. I've honestly tried to work really hard to, I'll call it under intellectualize this whole process, because I have a tendency to over intellectualize a lot of things. It's something I know about myself, right? Where I want to do something in an extremely complicated way and understand every single facet of it. And in reality, for me, when I found success trading was when I really, really, really simplified things. And most things in life, I think, are better when you simplify them as opposed to overcomplicate them. So I try to keep things pretty simple, and especially with the short-term swing trades, I really just use cash as a hedge. So my stops are what I consider to be a hedge. So and it goes back to, if I get taken out of 4 or 5 positions, especially on the same day, that's the signal to me, hey buddy, like you're not in the right environment. Take your foot off the gas. So that's what I consider to be hedging, honestly, is knowing when the signal is being shown to me to slow down. So I just rely on my stops and cash basically to get me out of losing trades.
I love it. Keeping it simple is key. Jack, what do you say?
Yeah, no, I don't hedge either. Like Matt, I go to cash. I may buy I may short via triple leverage ETF, like SQQQ or something like that. But I keep those positions very small too. I don't like to short, to be honest with you. But if it's there for a few days, I may I'll take 10 or 15% or whatever that position may give me. But yeah, I don't play options either. I've tried options and it just, it doesn't fit my personality. It's probably because I didn't, understand them as well as like you do, Rosanna, or other people. But it just, I'm more comfortable with shares. So that's what I stick with. But yeah, no, cash is fine with me. What, if I need to hedge, I probably shouldn't be in that position to begin with. And so that's kind of like the way I approach it, right? I don't care how great the company is or how great the story is obviously not doing well. And so I could just buy it back at a lower price at some point in the future, right? And even have to buy it back at a higher price, but the market's in a better condition. It's still to my advantage, in my opinion, versus hedging. But that's just what I go through. How about you? Do you hedge, Rosanna?
I love that. You know what? I'm going to just stop 1 second. You guys make sure you're following Jack and Matt. They are so amazing at what they do. And they're such great traders and so smart, both of them, but they're great people. And that's so important. They're honest and they're transparent. And that is so important. When you meet people like that in life, it's so important. So make sure you're following them both. They're straight shooters. They're going to tell you how it is. You may not like what they say, but you know what? It's a no fantasy zone. It's reality trading only, right?
Well, the
So,
same to you. I mean, I think the reason why I like this format here is because I really respect both of you, and quite honestly, it's hard to find, real down to earth people on Twitter, I believe, right? So when you get a glimpse at somebody's actual reality, I think it's much more helpful than any fantasy that we see out there, right? And I think you guys are both soundly grounded in reality. So that's what I appreciate about having discussions with people like you guys. So Rosanna, definitely recommend everybody follow Rosanna as well. So both of the people on this call right now, I have a lot of respect for, and just at the risk of seeming overly sentimental, I think it's hard actually to find people on Twitter that really do resonate with you. And when you do, I think you really have to take advantage of that, because that's one of the amazing things about social media, which I am not a fan of social media. I took a 10-year break from Twitter. I think it can absolutely bring you down. It can be absolutely a cesspool if you let it. And that's never going to change, right? It's how you react to it and how you treat people. And both of you guys are just awesome and uplifting. And I appreciate all the feedback that I've had from both of you and all the interactions I've had with both of you.
that means so much to me. Thank you so, so much, Matt. I the same. Never been on social media. I had a Facebook that was solely for chess. Our kids, I don't know if I've told you, our kids were professional chess players. They still are. They were homeschooled. They were all masters and experts. We did the chess life for 5 years or more.
Awesome.
Actually, you know what? Thank you so much. Maybe like 10 years. I don't even, 5 year was like world traveling. It was like crazy stuff. And, they play adults and everything. So I had Facebook only for chess. It's a private account. It's my chess world. I have like amazing chess, like grandmasters who are friends, like Fabiano Caruana. We met him too, but I'm not going to go into chess. Point is, never done social media until Twitter. And this is like my first experience. It was like, I think I opened my account February of last year or something, but I didn't really use it until last summer. And you are so right. It's like, there's so much out here that's like, you got to be really careful. And I've met some not so great people, and it's unfortunate. And I've met some amazing people like both of you. And there's just so many I'm so grateful for. And, and when you meet the great people, definitely keep them in your network and stay together. And this is great. I really, really appreciate it so much. So thank you. It means a lot to me. So, you guys know, I had a life outside of Twitter. Obviously, I have a lot of businesses. I read a lot. I'm an entrepreneur. I don't like to say I'm a successful person. I mean, I think you both are. You're extremely successful. You can tell by just the way you are as a person. You're successful in life, and that's what's most important. I have a great network in real life and great people. And this is just a tiny little part. I mean, and we made great connections. But I read a lot, and I do believe that trading should be boring. And there's this thinking about that. Like 2020 changed the image of trading. They made it like a casino. It was like fun. It was exciting. But real investing and trading should really be boring. So when you start sensing in a trade that it's like you're getting excited or you're getting all these emotions, maybe that's when you need to step back too, because it does need to be a little boring, and you need to take the emotion out. And I agree with keeping it simple. Avoid the overthinking. And it's just, don't overcomplicate it. Just like the chart, I try to keep only a few lines at a time and just look at it in a clear way. Simplifying things is usually best. Like less is more, quality over quantity. And we know that from like real life, and you can apply what you do in real life into trading and vice versa. So I try to keep things simple with my decision making as well. I mean, that's one of my areas of focus with my degree and my studies and my consulting was decision making processes. So you want to just eliminate, you want to divide and conquer. That's a really important concept in decision making, is chopping it up. You know, there's always problems in your daily life and business and trading. Trading is like business and like life, you know, and it's like you want to divide up those big problems into smaller problems, and you want to keep it simple. The whole point is isolating and being able to focus and zero in on the issue. So, but okay, enough about that. Okay, so basically, what am I doing hedging wise? Okay, I'm not a hedger type. I'm not the kind of person who puts hedges on, because I always feel I don't like that loss, because it's like I have to lose, because I'm either gonna like either my portfolio is gonna lose or that one's gonna lose, and I just don't like that thinking. I prefer to have cash. So I'm a person that if I'm not gonna go long, I'm gonna hold cash. So that's my thinking, because you know there's some people, I remember even in 2020 they were hedging their portfolio. They're like, oh, this market is too good to be true. I'm buying hedges, you know, I'm buying protective puts on my positions. I never did, because I'm just not like that. I rather just say, you know what, I'll reduce my position size and that's it. So I rather have cash, because and then they're like, oh, but if my stock keeps running, who cares about that hedge? I'm going to make up for it. I'm like, but to me, I still taking that loss for what reason? Just so I sleep better at night? Not really. I actually don't. I sleep less, because I'm like, I'm going to have to lose at one point. Either my hedge or my position is going to lose. You know, maybe I'm overthinking now. But the point is, I prefer, like both of you, cash. However, in this market where we're in a downtrend, I am picking up SQQQ or SPXS small. That's very important, in a spread. And when I see the market runs too much. And that is, for example, this past week. When I saw we were really green, I got to be honest with you. I did not think it was a new bull market. That's just me. And I'm open. Look, you guys all know me on Twitter. I'm very straightforward. I'm honest. I'm open. I talk about my positions a lot and about what I do. I call out tickers. You know, I love sharing and helping. And, you know, I'm just, you know, straightforward. I did not think it was a bull market. I actually think it was a bear market rally. So when I see that, I added SQQQQ, SQQQ. Okay, that's it. I don't want to add too many Qs there. And small. I was like, you know what? To me, that was like a swing trade. So I said, you know what? I'll swing trade. I saw an opportunity. When I see the market running, I was like, you know, it's an opportunity. And so I picked it up and I got the January, because I like to buy like within, I'm not a person who buys the same week. I don't do weeklies really, not in this market. So I buy like about a month or 2 months, all the way up to 6 months. I just like to give myself time. Sometimes I buy like a year, you know, I bought longer ones, but lately I've been buying through this window. And then when I sell, I wanted to mention that too. When I sell options, I do 2 to 6 weeks. That's like a sweet spot for me. Depends on the delta, the premium and all that. And the stock, of course, the sector and everything. But yeah, so that's what I did, because like I just had this feeling. I was like, you know, I just think this is a bear market rally. So it actually worked out today. I mean, it doesn't work out for all the time. Of course not. You know, we're traders, you know, we're investors, you know, it's just about, I love the point about your average winners against your average losers. It's not about having 10 wins and 5 losses or vice versa. It's about your weight. So it's about the total dollar weight. So, you know what, if I win 1, lose 2, but hey, that winner was, you know, significant, then that's great. So it's about your average winner, the weight of that. So my hedging is selling covered calls as well. When I see a stock runs really high, like, you know, there's quite a few of them. When I see it run a lot, you know, some people take a little profit. You know, I don't do that usually. I mean, I can't say I don't. Sometimes I do. But I will, if it's a long position, I sell covered calls against it. And I have to tell you, in this market, and I've tweeted about this, covered calls can be very forgiving because it pulls back. So sometimes I've had to roll them out, and I'll roll them out like another month or sometimes 2 months out. And then eventually they've expired worthless. It's been great. So in the past, when I sell covered calls, I sometimes I let the shares get called away. I mean, I don't get, sometimes I'm like, you know what? I already put it in my mind when I sold them. I'm like, I don't mind selling a portion of these shares at a certain price. So I let them get called. But in this market, it's been really great. I've had to roll out a few times, but they've expired worthless because the market pulls back. So it's been good. And my delta for that is 0.2 or 0.3. It really varies. And remember, the delta means it's the percentage that strike will be in the money at expiration. So then if you want to go less, if you want to have a less chance of it being in the money, you go like 0.1 or something like that. So it all depends on the stock, the premium amount, time period, and so forth. But my time period is usually within 2 months. I sell them. And I don't really buy protective puts. I have on some like Enphase because it's a high roller. That one's a high swinger. I've been in that one since July 2020. So I have a lower cost basis than now, and I'm holding it long term. The growth story's there. The fundamentals are beautiful. I mean, I go over those earnings all the time. You know, there's quite a few companies in here that have great earnings in this market still. You can find them. And so with that one, I bought protective puts. I don't have them right now. I've had them in the past. And you can do a collar as well, which is sell covered calls and buy a put. So I only do that, buying a put, protective put on stocks that are very volatile. For example, Enphase. So like Enphase, if you get it when it goes down, it'll go down a lot. You know that. I know, Jack, you watched that one. So it's a high swinger. So that's just the way it trades. People call, oh, it's a meme stock. No, it's not. It's a fundamentally sound company. Fine, the PE is high, but I don't look at PE as much. I don't give PE as much weight when it's a high growth company that has record quarterly revenues and has earnings per share up triple digits year over year, and free cash flow and like 30%. The free cash flow yields, I think 30% or something. But anyways, the point is that a high swinger like that, I'll buy a protective puts. That's different. But a slow mover, no, I don't do that. I'll just sell covered calls and call it a day. And that's my type of hedge. That's just basically, that's what I would do. I don't know if you call that a hedge. I guess you do. It's just part of the options trading, some type of risk management. It's a slightly bearish stance on a stock. But that's it. I'm sorry, I probably talked too much, but anyways.
I think it's good to hear all of that because when I initially thought about getting us together, I was thinking about getting people on different time frames, right? And I think I was incorrect in thinking that a lot of your trades are much longer term time frame, but I think it makes a lot more sense to do strategies like you're talking about if you want to have a longer holding period, right? So it makes a lot more sense. So it doesn't make a whole lot of sense for me to sell covered calls on something I'm gonna have for 3 days, right? So
exactly.
That just doesn't make any sense. But if you're into a stock because of the fundamental story and you're going to hold on to it, I think it makes a ton of sense to hedge the way you're talking about. It's just, it all depends on your kind of holding time frame, and that goes back to expectations.
Exactly. Thank you. Exactly. Yes, a long term, and then I do these options, so I'm making an income basically on my Enphase, even though I haven't sold it, I've held it. I've been making some good money on selling because there's high premiums on Enphase. So it's a great stock to sell options on because of the high premiums. So
side
yeah,
note,
it's been great.
I signed up. I was looking at their website and I left my contact information, right? Because I was just curious about what they offer in terms of solar installations and things like. And I cannot get them to stop calling me now.
Oh my God! Yeah, they're aggressive. They're good. That's why they have record. That's why they have record revenues.
Right.
They're aggressive, and I think they also got some great. They have this great customer support. Like they have these great numbers. Yeah, I guess they're aggressive. Sorry about that.
But it's certainly not your fault. I just think it's an aggressive sales technique, and it's obviously working. But it's just hysterical because they're just relentless on me. They probably called a couple times while I've been on this.
Oh wow! Well, that's good for us shareholders. That's a good thing.
It's good.
Thanks so much, Matt. Jack, I think I'm on the next question now. We've been talking so much. Okay, so you know what? Maybe we'll go with Jack this time because we've been starting with Matt. We're going to rotate it a little bit. What are your expectations? So we talk about reality-based expectations, like Matt said earlier. I love that, and he does reality-based trading. And your expectations, are they in alignment with the market and so forth? What are your expectations regarding risk management, expectation alignment, and so forth?
So once I create, an idea of what kind of market I think that we're in, whether it's a bull market, a bear market, choppy market. So that helps create what my expectation is for any trades I'm going to put on, or how my current trades on may react this week. So, if I think that we're in a bull market, my expectation is I bought something and it should move higher. I wouldn't be buying that stock if my expectation wasn't that it was going to advance in price. So that's got to be my expectation when I buy it. Again, going through my entire process, and everything lines up with what I want to do. Now, with that being said, you know what? Week happens, and the price vacillates, and let's say I do get stopped out, and it's kind of like what we talked before. There's no like, I'm at peace with a stop out, because I understand that stop was a gift. That stop was something that saved the rest of my account from a much bigger loss, potentially, with that trade. So I don't look at getting stopped out as a bad thing, and I think maybe that's the most important part, is that it's actually the gift. I'm thankful for that stop, right? Because that stop did what its job. It did what it's supposed to do. It stopped, my account from taking a bigger loss. Now, like Matt said earlier, sometimes, a stop gets hit, and then boom, it zooms right back up. Maybe the stop was too tight, right, or something like that. Um, and that's going to happen, and that's just part of trading, and that's what we have to deal with, what I'm saying. But more times than not, that's not the case. More times than not, we're gonna stop's gonna get hit, and chances are that position is probably going to continue on that same trajectory downwards. So as far as expectations, again, I'm getting into a trade for it to go up, and if I don't think the market's aligned for me for it to go up, there's no reason for me to take that trade, which means sitting on my hands and sitting in cash, or just managing the positions that I currently potentially have on. But that's it. Those are my expectations. It's real simple as far as that goes. I don't ever expect. By the way, I don't do targets, like price targets or anything like that. I once we're in a trending market, I let that trend kind of guide me, and I may trade in and out and around a position depending on, if it gets extended from its moving averages, I may trim some. Then if it consolidates back into the moving averages, I could add some more back in, and so on and so forth. And so I may trade around a position like that, but I'm not going to put a price target on it in a healthy market. I'm going to let them trend higher, and then when the market says the trend is over, it will tell me. What does that mean? It means that I'm never going to catch the bottom or the tops, but I'm hoping to get the meat in the middle, right? And that's okay. And it means also, most likely, that I'm going to be long when the market tops, and then I'm gonna give a little bit back as it comes in, and starts to break down. And again, that's okay as well, because again, that's part of what I understand that price is supposed to do. And for me to get the most out of that trade and stay in the trade as long as possible in a healthy market, that's part of the territory. So those are my expectations, right? I'm expecting to be long at the top and to give some back, right? And I'm expecting to be, I'll call it, late to the party, or I want to see some confirmation. Usually, I'm not buying bottoms. I want to see a little bit of confirmation, or some at least relative strength on something before I'm going to get in a particular name.
I love that. So Jack, is the trend your friend?
100%.
I love it. Awesome. So Matt, tell us your expectation alignment, which I think you coined that term. I love it.
Yeah, I mean, it's not exactly a miracle term or anything, but that's just the way I think of it. Because I just want my expectations to be lined up with what I'm trying to achieve. Because, and I touched on this earlier, so I don't need to run through the whole thing again. But I think for me, I need to have my expectations in line in terms of duration and outcome, right? So I want to have the duration of an understanding of what trade I'm placing. Am I trying to take a position trade? Am I taking a swing trade? That's gonna weigh in on my expectations for how long this trade is gonna last. And then that way I'm not confused or second guessing myself, or even worse, changing the entire trade plan in the middle of it. And I know some people will, enter a trade and then say, I'm gonna let this run out. And I'll do that as well. But that's always gonna be a partial that I'm gonna let run out. Like, for instance, if I take a swing trade, I know I'm queuing this up as a swing trade. I've got a position size. I've got the whole logic of the trade set up. I've got my trigger. I've got my stop. All that, the basics, right? And I enter the trade, and so my expectation of a swing trade is going to be, especially in this market, 1, 2, 3 days, quite frankly, right? And if I don't take partials along the way, that means I'm not in alignment with it, right? If I suddenly find myself thinking, hey, maybe we're in a new bull market, I'm gonna let this run out without taking a partial, that is not being in alignment, like I mentioned before, right? But I will occasionally test the waters, and I did it this year where maybe I took 2/3 off, and then I'm gonna test the waters to see if the market has the strength to let that 1/3 of a swing trade turn into a position trade. And in that case, I will probably use a moving average that the stock has respected in the past, let's say a 20-day simple moving average, and I'll have a soft stop on a close below the 20-day. And that's an example of letting it run out and sort of a hybrid between a swing and a position trade. But that's not changing what my expectations are. So for me, it's really important to know when I place a trade, what are my expectations? Am I basing it on reality, or am I basing it on a fantasy land that's going to get me into trouble when inevitably that fantasy land does not come to fruition, right? So if you place on a swing trade and you think, hey, I put this trade on based on having a stop that's 2% below where it is now, but now I want it to run out and maybe let this stock run 300%. That is getting confused. That is not having your expectations aligned, right? So I try to really, really avoid that, make sure I define what my expectations are, and it keeps me in check. And I think, I wanted to key on something Jack mentioned a while ago, about how this market is just unforgiving. And that's a huge difference between 2020. 2020 was fantasy land market where literally, I mean, very literally, you could buy a stock in the morning basically just by picking it out of your watch list, and it's likely to go up. I mean, that was literally the environment we were in. This is a completely different environment. So if you didn't have your risk management system, your basics absolutely nailed down in 2020, you're probably not in the market anymore. You're probably not participating in the market anymore. And this is a market where you absolutely have to have a firm grasp of risk management. And it's not just where your stops are and your position sizing. It's understanding when to hit the gas, when to take partials, when to raise your stops, when to get aggressive, when to get defensive, when to not participate at all. All of that is intertwined in my book. It's all a risk management lens. And if you don't have an understanding of how to do that, my primary way of doing it is, certainly I'm watching the market and looking for strength and following trends, but my primary way of doing it is understanding the feedback I'm getting from my setups. If you don't have something that's giving you primary feedback and something that's giving you a way to judge when to get aggressive and when to get defensive, you're just getting eaten up in this market because we're getting constant reversals. So the forgiving market of 2020 is long been history. And I think what happens is the people that were kind of born in the 2020 market or lost their discipline in the 2020 market, take your pick, start to blame things that aren't to blame in a market like this. I work with traders a lot, and one of the things we do is go through specific trades and we look at the logic of their trade. And if the logic of their trade made sense, yet it was a losing trade, next, move on. That's it. It has nothing to do with you. It's not something to be taken personally. It doesn't mean you did something wrong. It doesn't mean you're a bad trader. It means you're trading in the wrong environment, or simply the fact that when you have a 50% hit rate, 50% of the time you're going to be wrong, right? But I think the knee-jerk reaction for people these days, especially newer traders, is to think I'm doing something wrong. I must be able to figure something out to fix this, instead of understanding the environment we're in. So that all goes along with expectations. I think people expect to pull tons of money out of the market in all environments, and that's not reality. And that's one of the things it's interesting because, again, I'll go back to this interview I did with Oliver, who I think is still on here. And he asked me, what are these questions you get? Because I do one-on-one coaching with a small group of people. And the biggest things that keep coming across to me are that people really have a way of blaming themselves when things aren't working, when it's really the environment and not their logic. If I see something in somebody's logic that is incorrect, like this entry makes no sense in terms of what you're telling me, or the way you're looking at this trade, the way you executed it, they're in conflict with each other. Those are mistakes that we make as people, as traders, that we can fix. But if you have a logical reason for taking a trade and you execute the way you were planning on executing and didn't deviate from that plan and it doesn't work, and that happens over and over, you're in the wrong environment and you need to slow down. So it goes back to the expectation of, I think that one trading axiom that gets a lot of people in trouble in this market is let your winners run, because we are not in that environment. And while people want to be that environment, that's not the environment we're in right now. So that is a big way of aligning your expectations with things, just understanding the environment you're in. And I know I went over this before, so I won't belabor the point, but that's how I look at it. I try to make it as simple as humanly possible and just have realistic expectations to keep me focused. And that's how I look at it.
I love it. I see what you mean, Jack. No one wants to go after Matt. Maybe we should rotate this order again. Anyway,
Right?
I know it's not fair. Okay, Matt, you're too good. You're awesome.
Oh, stop it.
I love it. You're so good. Honestly, you're amazing. I love what you say. You're a great speaker as well. Both of you are. But
You guys are as well. Thank you.
okay, thank you. But I'm going to tell you, I'm going to beat you on this one. I got a better axiom not to follow in this market, better than letting your winners run. Does anyone have a guess? Don't buy the dip. Buying
Yes,
the dip.
that's toast.
That's the worst one. Don't buy this dip. Okay, so the axiom of buy the dip does not work in this market. Be very cautious.
Well, I also like the way Brian Shannon talks about it too, because it's not the act in my world, and I agree with like almost everything Brian Shannon says.
I love him. He's awesome.
In my world, it's not like don't buy the dip, just don't buy the act of a stock dipping. You have to see it actually turn around again.
Yes.
You want to buy the bounce after the dip.
Yes, you want to buy that reversal. That yes.
I
love
what makes
him.
sense to me, right? But that buy the dip phrase is, I mean, that has been beaten into the ground in 2022. That's for sure.
Yeah, exactly. So yeah, Brian Shannon's fantastic. I know he has a new book out. He's amazing. So I'm glad you mentioned him. And Matt, you're awesome too. Both of you are great. So this has been wonderful talking about this stuff. I'm just going to add a little more to this. You know, so there's this difference between skills and execution. And you touched upon that, Matt. You know, it's you could know all about a stock. You could know all your best technical analysis. But if you don't execute it properly, you can lose. So it's all of those elements. So you have to be in the right state of mind, you know, and the market is working against you. So, you know, it's a lot of factors. So you have to distinguish your skills from your execution. Just because you know all these things doesn't mean you're always going to execute well, which is why you need to have risk management. You know, we all make mistakes. We're human. And you know what? You could do everything right, and then the market goes the other way. So you got to have a way to get out. And I like that fast stop, you know, getting out if it goes below the low of the day or so forth. You know, you're aware that the market right now is not the 2020 market. It's not even a regular market. It's a difficult market. It's working against you. It's a downtrend. It's choppy. It's all of that. So, you know, expectation is just to know that it's a difficult market. And I try not to let like a swing trade, like you said, a few days, go to a long term. You know, I have done that before. But that's a rule. It's like you got to stay with your time frame and your trade. And you got to cut it. If it doesn't work for your time frame and your plan, then to change it to a long-term holding when you never wanted it to be, that's sort of breaking a rule too. So try not to let the green go to red. And that's another important concept too. And that's why I scale out. In this market, you don't let the winners run. So you just take the money, you just take your profit. And you know, your feedback needs to match your expectations. So if the feedback you're getting from your portfolio isn't matching your expectations, then you need to reassess and find out what's going on, and then use that information for your next trade and say, you know, maybe my expectations aren't right for this market. Maybe I need to reassess and figure it out. You know, you need to take that information to always be learning from it. It's like a constant feedback loop, and you're tweaking your plan and your strategy. You know, it's about being flexible and always changing and always growing and always learning. You know, the trading is a beautiful thing. It's you're always learning. You know, part of being a trader is always learning. We're all people who love to learn because the market gives you something new every day. And there's always something new. I'm always learning. And that's the key here. So you're always tweaking that loop, that feedback loop, and you're always modifying and you're growing and hopefully you're always improving, you know. And what I like to talk about briefly is cost benefit analysis. And I use that with everything in life. And I mentioned it earlier. I use that with my business decisions, and I make decisions all day long. I mean, as an officer, of a company, I make decisions all the time. That's what I do. I delegate and we do more of a democratization of leadership in our business. And I like to let other people make decisions as well, but I'm making decisions all day. Trading is decision making, right? It's all about decisions. So learning how to make proper risk adjusted decisions, taking, calculated risks, whatever you want to call it, risk adjusted returns, taking that all into account, looking at the cost benefit analysis is part of the decision making process. So I'm always assessing what can I lose first. And I know that unfortunately, a lot of the people who started trading 2 years ago see the other way. What can I make? And it's unfortunate they were taught the wrong way. And I'm sure a lot of them who've stayed in the market now have modified their strategy and they've learned, but it's very important to know that you should always assess what of my money am I going to lose? Let's say I put $100 into something, and if I have a chance of losing, half of that, I need to know how much more I could possibly gain. And then I assign a weight to that. Like if I have, if I have a higher probability of winning over losing, but the win amount is lower than the potential loss, then I may still take it. And alternatively, if the trade loss, if the probability is low, the trade amount is low with the higher probability of it occurring against the potential for a higher win amount with a lower probability, then I may still take it. So they can balance each other out. So it's about probability and the amount. It's not just the amount. So I think you sort of understand that. So I look at it in that way. So it's really important to always assess, what am I going to lose first? And then you look at, what could I win? And then you compare that in a cost benefit analysis. And one last thing, ignore the noise. It's important, especially with social media, that you see other people flashing gains, or they call it gain porn or whatever it's called. I'm such a dinosaur. I was talking to Matt on the phone, actually. I was like, I'm such a dinosaur with a lot of this stuff, I don't know these terms and everything, but I'm learning here. I guess it's good I know for my kids and everything. But gain porn is a new word here that I learned, this year, but or last year, whatever. But and they can lead you to feeling fear of missing out. And then you're going to change your expectations. You're going to think, oh, if this person's doing it, maybe I can too. And maybe what they're showing you is only partial of what, you don't know the whole story. Just like in life, you don't know the whole story about someone. You see them win, and that's another thing that we know, survivorship bias. We see, oh, they're winning. There's this. It's because of that trait or something. Or we always see one side of a story. So let's not assume that that's fully correct. So when we see them flashing their gains, we're like, oh, maybe I should change my strategy. Oh, maybe I'm doing it wrong. And then you take what is somewhat working a little bit for you and you modify based on someone else, and then you end up losing bigger. And so it's just important to just have your expectations not affected by outside noise. So just try, it's one thing to learn, and learning is different than getting swayed by other people's, winnings, because you don't know the whole picture. So I just wanted to touch upon that. So now the last question, and before we get to closing, but to me, very important. How do you reduce emotional trading? Jack, you go first.
So that's not easy to do, obviously. And I think, honestly, it's through desensitization, right? So it's about getting beat up in the market and time spent in the market trading, and over time, it kind of beats it out of you, for lack of a better term. And that's okay. That's kind of like the process. So you can't read a book. You can't read Mark Douglas and figure out what makes you tick and cure yourself of emotional trading and FOMO if you're missing out. Um, you know, it's it's not easy, but eventually you get to the point if you could grind through it. And that's why if you look at FinTwit, you see, if you've been on here long enough, you'll see people come and you see people go. And it's a rotating door and it happens a lot. And it's because people aren't willing to put in the time needed to go through and to stop all of those bad habits that they think trading is, to get to the point of what trading actually is. But eventually, and I kind of mentioned it earlier, you get to the point where you kind of become numb to the trade. It's just a trade, and you may go up, and sometimes you're not happy that you're making money because you are, obviously, but it's not like like euphoria or anything like that. And when things come back down, you put solid risk management. And I'll be honest, I'm happy if I had a 5% stop loss, and if something stops and I stop out at 3% because I've been notching up, my stop loss, like we kind of talked about earlier. Like I'm like, oh hell yeah, I saved 2%. That's awesome. I'm pretty happy about that. But it stopped out. I still lost some money. And again, it's not like, but it's more of a numb feeling is the best way to put it. I just don't care. I mean, as far as that go, because it was the plan. I know that over time, right? And you kind of mentioned the statistics of it, and I know Mark Minervini is a big proponent of the statistics of it. You know what I'm saying? So your win percentage and your loss percentage, right? How much you gain, how much your winners gain, how much your losers lose, and how often you win and how often you lose, and that's your expectancy, right? And we know that during a bear market, we're trading smaller or trading with less of our account, and so it's just part of the thing. You wait for the market to give you the feedback, and if it's a negative feedback, then you raise cash. Like right now, as we were talking, something else stopped out on me. No big deal, right? It was part of the expectation. um it got stopped out, and so now I'm like 80%, 85% cash right now. And that's okay, because that was the feedback the market gave me. So that's kind of how I look at it. It's not even, it's like, I think it's time spent in the market is the only true way. Yes, we can study ourselves, we can study the books, we can talk to pro traders, but eventually it's going to be it's a battle against yourself. And once we get to that point, um that's when you lose the FOMO, and you lose all the other bad tendencies. Not that they're gone forever, but that's when it definitely subsides a lot. So that's how I feel about it.
Love it. Thank you so much, Jack. Matt, what say you?
Yeah, I agree with a lot of what Jack said, and I know Jack has to leave in 5 minutes, I think, so I'm going to be really quick. But I do think that it comes with time, like so many things. It comes with time, and one way to get to a point where trading is boring, which I think it should. I love trading, right? So it's never totally boring, right? But I'm not sitting there sweating. I'm not sitting there, pacing. I'm not throwing my monitor against the wall. I'm not like stomping on my mouse, And if those kinds of things ever happen, you're trading way too big and you're way too emotional, right? So I mean, trading is literally sitting there clicking some buttons and following a plan. Um, does that mean I don't get FOMO? Does that mean I don't see indexes ripping and feel like I should jump into everything? Of course, you still do. But the thing that happens over time is you recognize that that's what you're feeling and you don't act on it in a detrimental way. So I think that the way to get to a point where trading can be boring and you're controlling your emotions versus the myth of eliminating your emotions, because we never do that. We never want to do that. I mean, I don't want to be a robot. But I think the way you can shorten your path to a point where your emotions are under control is by recognize them in the moment. And I think journaling, one of the best things about journaling is just that. Like if you sit there and say, today I felt like I needed to jump in on everything because Qs were up 5%. You start to recognize that emotion. Just simply the understanding of recognizing it and coming to terms with it and actually writing it down, I think, helps you recognize it over and over again. And I think that over time, just coming to terms with those emotional peaks and troughs that you have, it starts to smooth out. So I think what you have to really do is start to, know yourself really well, right? And that the good news is we all know ourselves pretty well, hopefully. And if you can start to understand when your emotions are really taking control and leading you to potentially make a poor decision that is not part of your trading plan, the more often you can identify those times happening, the more often you can start to quell them and kind of smooth out the rougher edges. And for me, the goal is to definitely be kind of a boring trader, even keeled trader. I'm never going to get on Twitter and start screaming all over the place when you see. I always know there's like a novice trader on there where somebody is just absolutely chest thumping or furious or mad at the market. I mean, that is somebody that does not understand risk management or what's going on with their emotions and how that's affecting their trading. So long story short is I think over time, by recognizing your emotions, you can come to terms with them and control them better.
I love it. No chest pumping here. We're the no chest pumping zone. You just stole everything I was going to say. Okay. So there you go. Okay. For me, number one is know yourself. And I always say that. I actually keep it a little, sometimes I write it to myself if I know I'm going to be trading a lot or if I'm making decisions. I always think of myself because I know you got to acknowledge your emotions, and it's about identification. That is key. See, the psychology, the market psychology, you can call it, or psychology in decision making is 70, 80%. It's about you, your mindset. It's about knowing yourself, knowing what works for you, and knowing to identify your emotions. And so that's key. Most people just deny it. They don't notice it. They may know themselves, but they don't acknowledge it. And that's the big way of separating between intuition and emotion. So they making decisions based on intuition. And I have this whole thing I wrote, I might publish it, I don't know. It's about expertise-based intuitive decision-making. And that's a real thing. There's a great friend of mine, Sim, she's awesome day trader, amazing, okay? She makes decisions fast and she just feels it. And that's what that is. It's about intuition. It's when you're an expert in a field. I know Jack has to go. I'm not going to get into this whole thing, but I could talk about decision making for hours. But when you're an expert in a field, you've learned this tacit knowledge, this implicit knowledge. You have recognizable prototypes in your mind, and you pattern match at such a fast level, and it's intuitive. You can make those decisions based on intuition, but you have to separate them from emotion. Intuition and emotion are very different. Okay, so acknowledging your emotions. And for me, reduce position sizing. I'm going to keep saying that over and over again. A friend of mine, Simon Rhee, amazing, author of Tao of Trading, he talked about that too. He says reduce position sizing is a great way to reduce risk and reduce your emotions tied to a trade. So I like that as well. Establish your trading plan before you enter a trade. Follow it. Don't trust your emotions while you're trading. Your emotions they will definitely get the best of you in the middle of a trade. You're like, oh, this thing can go, it's going to bounce. It's going to do this. You had your plan, follow it. No fear of missing out, especially in this market. And, just don't chase because, it can get overextended. You'll jump in and guess what? Then it pulls back. So, because the stocks seem to be pulling back quite a bit in this market in the downtrend. So avoid impulse trading, delayed gratification, patience, don't rush. Mistakes increase when you rush. If you miss the trade, so be it. There are plenty of other stocks in the sea. So that's it. Thank you so much, all you guys. Any last words from any of you? Please speak now or forever hold your peace.
Just want to thank everybody, and Rosanna, you're awesome, and you too, Matt, for putting this together, and amazing people and traders, and again, appreciate everyone that came in to listen to us, and just stay safe out there. There's times to be aggressively long in the market, and there's times to play defense, and we're in clearly in a more defensive posture market right now. So just again, trade accordingly, and again, thank you all very much. Appreciate everybody. Take care.
Thank you so much, Jack. Matt, what say you?
Yeah, I'm going to echo a lot of what Jack said and appreciate him being on here. I know he's got to run, and thank you, Rosanna. It was a pleasure to talk to both of you. And again, like I said, it's just fantastic to meet people that are genuine and operating in a transparent way on Twitter. And it's been a pleasure to meet both of you and talk with both of you. And I do agree with Jack. Also, everybody should be careful out there. That's kind of the whole point of this entire conversation here that we've had, is that risk management should be a focus. And one of the things that I just want to stress to people, especially if you're new, is that if you're, you can't beat yourself up so much that you have absolutely no confidence left in this market. You want to keep sure that you have a full confidence gas tank for when things turn around. So if you're struggling, there's no shame in taking a break and being in cash. There's no shame in that. Some of the best traders in the world are having, mediocre years at best. So why would you think that as a new trader, you should be up 400%? You wouldn't expect your first year of medical school, you should go in and perform a double bypass as a cardiac surgeon. So there's no reason why you should expect unrealistic things as a trader, and keep at it. Things will change, right? So I'm always optimistic and want people to understand, where they stand in reality. So keep chin up and keep going. That's my main
Awesome.
line.
Love it. And I'm going to just end on a positive note. Love both you guys, amazing, real people. And connecting with you guys has made everything so worth it. I love you both, awesome people. Make sure you follow Jack and Matt. Remaining liquid amidst tightening liquidity in order to seize upcoming opportunities is key. So having cash is great. If you don't feel comfortable about a trade, hold your cash because opportunities are coming. Through every challenge breeds new opportunities. And that's how it's been historically. Through economic crises, when we thought there was nothing, no light at the end of the tunnel, there always was. And we had the best bull markets after the darkest days. So remain liquid, be ready, opportunities are coming. So let's seize these incoming opportunities as these are opportunistic times.
Great.
So thank you so much for everything.
Thank you, Rosanna.
Take care. Thank you to listeners. Thank you all you listeners.
Thank you everybody for listening.
Take care. Bye-bye.
Bye.
Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon.